The market continues to break through slowly more and more of these intermediate resistance levels. Are we ready now to trust this move and get going again here? Or what's really driving it? That's what I'm going to break down and see, okay, now that we've had a good few days and we're up above some levels that we were, that were holding us back, what can we expect now going forward into this options expiration Friday as well as early next week? And is this new bullish posture ready to take off? So I break all that down with a trade idea about on a stock that has an earnings coming up, but as a way to trade it without being impacted necessarily by that earnings. So let's go ahead and get started. Today is Wednesday, April the 18th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those of you who are watching us for the first time. Thank you glad you found us. Keep coming back for more. Subscribe to our YouTube channel by clicking on the logo in the bottom right corner of the video. If you mouse over that logo, click on that red subscribe button. Hit the thumbs up icon down below the video. That lets me know that you like the video, number one. And number two, it tells me that you want me to do it again tomorrow. It's a great way to give us feedback as we do these videos day after day. Comment on anything that stands out to you from today's video. You can scroll down further and see the comment section down below. Join our daily Market Outlook email list by clicking on the link in the description down there. Follow me on Twitter for more content like this throughout the day. You see my handle up on the screen at DavidSettle42. Like and retweet tonight's Market Outlook tweet. And then finally, join the Market Outlook community, again on Facebook, the address up there in the same spot. There's a link down in the description below that will also take you to the same spot. All right, let's go ahead and take a look at the S&P 500 here as it briefly starts to get up above, filling in this gap from March, but getting right up to that level. Just a smidgen above the 62% Fibonacci retracement that we hit up against yesterday with the breakout move we had yesterday. Monday hitting up against the 50%, so we're trying to clear this resistance, doing so with a light volume. We'll take a look at that here in just a second. The intermediate line has crossed up above 50, so a good sign for the bullish market from that perspective. Obviously a much higher near-term high than the last one, coming up off a near-term low point. We are now, let's see, how many days? 1, 2, 3, 4, 5, 6, 7 days. With the near-term line up above 50, which is what we want. It's gotten up into the upper reversal zone again. It was exactly what we want. Market sentiment's rolling up. If it V-bottoms up, that'd be outstanding. But most likely you're not going to get that kind of a big bullish move on market sentiment. It's probably going to base around here. But regardless, the posture is bullish, and it's a good sign. And it's strong, It's more strongly bullish now than it's been, in a while in this last couple of weeks, because it's finally gotten up above 50. And when it gets up above 50, we expect 1 to 3 month run on the intermediate posture. Now, it might kind of vacillate around here a little bit if we get any kind of short-term weakness. If we pop back down to this 2670 or 2675 level again on a near-term basis, you might get a little bit of a bearish posture and vacillate around that 50. But regardless, 1 to 3 months now is kind of that time frame that we look for an extended intermediate run based on that line crossing above 50, and combined with the fact that you're below 50. Now we're leaning more towards the 3 month end of things, the 2 to 3 month end of that time frame, or longer, as we saw, the last time. We were coming up from below 70, we got a 5 month run on the intermediate posture. So not very often we get market sentiment below 50. It doesn't happen very often when we're this bullish. And you notice, last time was back here before the election. So it's been, over a year since we've had this kind of low point that we essentially can try to buy ourselves off of at this time. Now, granted, you have some resistance coming down. If you were to draw a line coming across these candles as best you can, however you want to draw this, it's in this area here. Remember, this orange line is at 20%, 25% move for the calendar year. So that's the pace, and that's how far away we are from the pace. To get back to the pace, by the beginning of May, all it needs to do is get back to those old highs. But it's going to, most likely meet up with some resistance in this area based on that trend line. That a lot of people, we can take this one off now that we've broken it. Most likely we're not going to retest resistance line anytime soon. But the postures, the chart's looking bullish. It's looking good. We've had a good near-term run to get to this point. Don't be surprised if we start to run out of gas here a little bit. You can see the Dow Jones Industrial Average, it has broken through its level, unlike the S&P 500. So this line that you drew on the S&P, it's broken up above that, and you can see its posture is bullish, forming a little bit of an intermediate confirmation signal with an oversold momentum line combined with a bullish posture. A buy the dip signal essentially is what that tells you. Not the best buy the dip signal because the intermediate line is not above 80 where it's really strongly bullish, and the near-term line is not below 50 where we can set up for a good new near-term run. A little bit of a doji pattern developing on the NASDAQ composite today at right around 7,300. Its intermediate line is rising too, not quite above 50, but bullish postures looking better there. Bullish charts looking better there. And then finally on the Russell 2000, which has been more bullish than the rest, you can see it's really taken off. And a little bit of a long upper shadow suggestive, that we might get some short-term weakness based on that relatively long upper shadow there as we head into some old highs up into this area. So remember, its near-term line, like the S&P, has been above 50, 1, 2, 3, 4, 5, 6, 7 days. Rising markets, intermediate posture is already crossed above 50. So the posture's there for a bullish move, but that doesn't mean that we might not get some short-term weakness. We've been kind of looking at this short-term weakness, but in the last few days with all these other kind of levels of resistance that we've been breaking through pretty much all week, but doing so with lighter volume, which suggests that, that not to put a whole lot of stock into this kind of intermediate breakout. You can see on the S&P, not to put a whole lot of stock into that breakout quite yet, because we're just not getting the volume that would say, all aboard, so to speak. Quick reminder that if you're watching the Market Outlook video on the MarketScholars.com blog, to like and retweet tonight's Market Outlook tweet right here from the blog, so you can do this while you're watching. The goal is to try to get that number up to 150. We've gotten close. We've gotten to 142. So see if we can get to that number there. And again, here you can also do the same thing on Facebook. You can like and share it on Facebook. Our goal on the likes there is to get it up to 50 likes on the Facebook post. Again, you can do this while you're watching it through embedded here. Just come down and do a few clicks there. You can also like it here on the blog. Here you can join our daily Market Outlook email list, as well as share this blog post with friends and followers that you have as well. We've really got that green arrow now on that 50-day moving average with the moves we've had in the last couple of days. So we're easily back up above. That doesn't mean that we're out of the woods, right? We can get a nice good trend out of this, but expect more. We talked about getting more volatility on that 50 and 200-day moving average as we come down from peaks. But we also talked about we don't come down from peaks here in a straight line. There'll be ups and downs, and right now we're probably going to be on an up for a while. To where that 50-day moving average is probably going to gap back up away from the 200-day moving average, but don't expect it to get back up to 150 points anytime soon to get a gap that was that big like we've seen before. The 3 green arrow chart you can see has all 3 green arrows showing up on the moving average, the MACD and the stochastics. If you take a look at the 2-line versions, both the MACD and the stochastics are above their moving averages. We've got that first step. Of course, the 5 is crossed above, the price is crossed above the 8 and the 17-day moving averages. So we got that. Right? We did it over here. It didn't take. We did it again here. It didn't take initially. Okay, we're back up above that. Great. The next thing is to get the 8-day to cross above the 17, which it has. That's what brings the MACD above 0. So good sign there. The next is to get both these lines across above the 30, which is where we get that divergence away from the 30 to the upside. That's our next step. For bullishness. And again, I don't know if we'll get that until we test this resistance first, pull back down to this 2675 level, which is where that moving average will be again, as well as these shorter time frames, bounce off of them and then make the push up above that moving average there. So you can see how we broke through that resistance, and not surprising, now we start getting really small ranges. Today's range just over a point, about 1.5 points. and the volume starts to lighten up. It was a higher high and it was a higher low. We did not clear yesterday's high, so stuck in the middle of the range. And you can see here, you can see that the volume was even lighter than what we had yesterday at 56 million. The range, again, just under 1.5 points. So very, very light on both of these. So that's, which is okay. I mean, we expect that, but we've been getting that all week. So this whole breakout has been on light volume and smaller intraday ranges, not including the gaps. So we gap up in the mornings, and then once volume kicks in, we don't go anywhere. And that happened the first 2 days of the week. And then, today we didn't get the gap, but same thing as the prior 2 days, we didn't go anywhere. And so that's why I'm not too sold yet on that. We didn't get the big candle with the bigger volume. Not huge, but, volume around 100 million to 125, candle around 3 to 4 points is kind of what I was looking for to bust through this 2675 area, and we didn't get that. So, I think we're getting kind of this exploration week move where we're getting through these short strikes, especially that 270 strike, and then after with low volume, and then after this week is done, most likely, and that expiration passes, then we'll probably pull back down to this area and for another near-term low point that we can launch off of and continue this new intermediate run that we're on. That's kind of the expectations there based on how I've seen these work in the past. You can see that we have now formed this low point, this low on the volatility levels here, and we have now bounced up to a new one. So this is, you can see the MACD and the stochastics got above zero there. The MACD has, the stochastic has already dropped back below 50, but the MACD hasn't. So you can't necessarily call that a new high point, developed high point yet. And if it does, again, I wouldn't be surprised again if we did a whole volatility here and start to bounce up on volatility back towards that 20, with a near-term pullback in stocks. After this kind of low volume breakout move shakes out anybody who might be short strikes, options, around these levels on the broad market, these round levels in the broad market. Another reason why I'm not quite as bullish, in addition to the lower volumes and the light trading ranges, we're not able to get below 90%. The VIX isn't able to get below 90% relative to VXV either, and that's what you do need to get to be bullish. And you can see we even got up to 1 today again. 3 times out of the last 4 days, the VIX was at one point as the same levels as VXV. So we're kind of stuck in that neutral range. We're not able to really clear that 90%, which will keep us bullish for a while, which is what we'll need to get that intermediate line to stay above 50 for that 2 to 3 month period. We'll need that to happen. That hasn't happened yet, so I'm not totally bought into this new bullish trend yet without another near-term pullback to a most likely higher near-term low point than that we can use to get back in and start to move into newer positions that we might be able to trend trade here for a while. The biggest move of the day, when you take a look at what's driving this price action, continues to be crude oil. Crude oil inventories came out, were really bullish for crude, and you can see it's really, over the last 2 weeks, crude oil is up 8%. It's always the most volatile asset class, at least on this chart that we look at. Long-term bonds were the other bigger mover today to the downside, which means yields really taking off. Remember, yields are a reflection, especially in the short term, or intermediate term, rather. They are a reflection of inflation expectations. And of course, commodity prices are a function of inflation. You can see here's the 10-year note and the little flag pattern that we've had. Well, we're kind of breaking out of that and we're starting to rally again, which in my opinion means inflation expectations are rising again. That's going to have an impact on interest rate hike expectations. We're baked in the cake for the next one to be in June. September has got about a 80% chance that we'll get another one in September. And of course, December is the main one. It not much of a move today, but about a 40% chance we'll get the third one by September. That's the number to watch, right? The 225, 250 level. When you look at the charts here, that's this one right here. You can see it's rising, and whereas there's the odds of a second one, and then there's the odds of only one by December. only one rate hike. So the odds of getting that third one are starting to ramp up as inflation expectations are ramping up, and that's reflected here. And a lot of that's really coming from what we're seeing in crude oil. I mean, the crude oil is breaking out. Look at that breakout move that we looked at before here. We had the pullback move, and now it's really taking off. And there's, if I were to, really zoom out on the volume on this, and I have to really zoom out here, so bear with me 1 second. Let's take off the cone. So we don't have that big move to the other side. And then let's take off here. Studies, bear with me 1 second. Oh no, time frame. And let's go back. Okay, so there's the volume at these levels. Not a lot of trading at these levels. So move to 80 is going to really be easily in the cards here. And that's what a lot of people are expecting. To get back up to 80, if not eventually up to 90, where you'll find some, and of course around 100, if it breaks 100, there's a long ways for this to go. But of course that it's going to find a lot of resistance now in this 80 to 90 to 100 area. But that doesn't mean that we can't now create, we've been stuck here in this range for so long that now it will form a new range like it had before to 2014, albeit at higher levels. And of course, that extreme high on commodity prices is usually the signal of a really bullish market, a mature bullish market that may be making its way now towards a recessionary type market. And one thing too that's been in the news quite a bit, and that is that yield spread. Right, looking for that inverted yield curve, the flattening yield curve. Well, that yield curve, and this is the 30 versus the 5 here, continues to really flatten. If you take a look at the long-term view on this chart, it's been a long time since we've been falling to these levels. There's been a lot of people talking about, we were here before, at this point in 2007. Right, we were here before in 2007, in July of 2007. Remember, the market peaked right there in October 2007. That's when the market peaked, and we had our recession right there. But again, we're not rising to 315. We're falling to 315, which means we're more in this area here. We had a little bit of a bounce. It was around 5%, so a little lower. And we had a bounce here too, around a little above 5%, and one a little bit lower, below 5 points, excuse me. So, this isn't, it doesn't necessarily have to free fall, but you notice when we get to these levels, it really does kind of free fall to the point where it gets to zero really, really quickly. But even then, the yield curve, in this case, 30-year to 5-year, got to 0%. The spread between the two got to zero and inverted in early 2006. And that was, again, if we're looking at the last time, let's say after this bounce, even if you were to play it safe, that was, about 6 months after we had gotten to these levels before. And that was more than a year and a half before the market peaked, right? So almost 2 years before the actual stock market peaked. So you'll hear a lot about the flattening yield curve. Just know that it's actually really bullish. Remember, the Fed stopped raising rates here in the middle of June. So they got it to the flat. They stopped right there in the middle of June, or June of 06. So right there actually is when they stopped raising interest rates. So they got it to that yield, to that flat spread. They didn't want to go any more because, again, the 5-year note, in this case FVX, is a measure of, is more correlated to what the Fed's doing with those rate hikes. You can see it's really been rising since the Fed's been raising rates, whereas the 30-year is more a reflection of and that's a reflection of inflation expectations. The 30-year is more a reflection of economic growth expectations, and you can see it has not been growing very much. Now granted, it's been rising a little bit, and it's up today, but when that rises, that means economic growth expectations are rising. When the 5-year rises, or especially like when the 90-day T-bill rises, that's a reflection of, in this case, the Fed's rate hike expectations, and then of course the 5-year would be more a reflection of inflation expectations. And so they all rise kind of together, but you can see these shorter time frames will rise a lot faster than the 30-year will, especially when inflation expectations outpace and interest rate hike expectations outpace economic growth expectations to the point where you get a flat yield curve, right? And that's what this, so now you saw the difference between how steep those lines were. The fact that those shorter time frames have a steeper line means to push this down. And that will continue to come down as inflation rates start to grow. And high inflation is not a bad thing. Now, really high inflation is not a good thing. But, growing inflation is not a bad thing. That means the economy is growing. That means prices are going up. Prices only go up, like commodity prices go up when they're being used, right? And they're being used to fuel economic expansion. So it's not a bad thing. And you saw it's not a bad thing for the markets either. It's not an immediate, especially falling yield curves is not a bad thing. Flattening yield curves. Now, when it gets inverted, that means the Fed's raised rates really fast. Or at least they gotten to the point where it's kind of hard for them to keep raising rates. Unless economic growth expectations start to really ramp up big time, which, again, that's not what happens when you get that inverted yield curve. So that's when we'll know they'll be done. And as of right now, when is that going to happen? Well, the futures market doesn't think it'll be by the end of this year. So we're not anywhere close yet to that inverted yield curve, at least according to market expectations. Of course, that doesn't help. Of course, the energy sector really benefits from this rise. So this little 3-day breakthrough rally we've had this week. Energy stocks have kind of been helped out big time by that. Initially, it was the safe haven, staples, utilities. They did well. Then you can see technology, discretionary did well. On Tuesday with earnings coming out, pushing them higher. Materials continuing to be strong all week. But you can see here today it was energy stocks that were lagging the market by the end of yesterday. Now one of the best performers for the week today. So they've really taken off. Staples, which started the week really strong, are now one of the worst performers with those rising rates impacting those dividend payers. And it's really impacting a financial sector. The falling yield curve, flattening yield curve is really impacting that financial sector negatively. You can see it's up, 0.5%, but not the broad market as a whole is up 2% for the week. It's a pretty good move for a week, and it's not getting any participation from these particular two sectors. Utilities are, they started the day strong. They pulled back today. So if I just look at today, you can see utilities, real estate, staples, financials, all pulling back, and technology too for separate reasons, the earnings reason. But these are all interest rate sensitive. Some more to utilities and real estate more interest rate sensitive than others, than staples, but staples still struggling. Whereas on the other end of the spectrum, you can see with commodity prices rising, materials and energy rising, and then of course with industrials would suggest decent economic growth expectations. So move back out now to the week that to this week bounce. That's what we're getting rallies in: industrials, energy, and materials. Those are three sectors that you would tie with rising economic growth expectations. One stock that also is a reflection of that economic growth expectations is Home Depot. It's more of a consumer stock, and a stock that a company that we've frequented here lately, and a reflection again of consumer. It's a consumer stock, but also kind of a home building stock, and it's a good sign of economic growth expectations lifts areas like this. And you can see this stock did really well today. It's earnings coming up before May expiration. You notice its earnings here is at on 5/15. Options expiration is on 5/18. So if you want to take a look here really quick at the May 30s, you can see if we were to sell right now. Here, let's move that. Let's leave that mark here for a second. If we were to see which ones did I pick, the delta, based on the delta, nope, not that one. I believe here, let's go back to the delta. There we go, the 175, 170, that's what I thought. 175, 170, You can see I'm not getting a lot of credit. I'm not getting that 30% return because I'm not 45 days out. I'm closer to 30 days out, but still a pretty decent credit because of that higher volatility. Now, one thing to keep in mind about the volatility is, while we're pushing up against the Bollinger Bands there, if you look at the implied volatility, it's already pretty high relative to where it's been in the past for earnings announcements. Now, not this one here because we were coming down from this big drop we had in the markets. So, so the implied volatility doesn't have a whole lot of room to go up anymore. And there's been kind of some precedent for it to, where is it? It's right here. There's been some precedent for it to come down even heading into earnings. So you can see a little bit of a downward move a couple of days heading into earnings before, boom, the earnings drop on the dotted line there. So we don't have to have, this thing make a move in implied volatility. So I wanted to see, okay, well, if I did the Theo price, and let's just reset the stop price for a second, to 515, so through the end of 514. So by the close of 514, because earnings is on 515 in the morning before the market opens. So if I were just through the close, you can see this $1.05 just from time passing alone and no change in volatility, because again, considering how high it already is, then the time passing alone to get to that date will bring this option down to 17 cents if the stock stays at 180, right? If it stays roughly around 180. Now, if you recall, the week before, the at-the-money straddle is priced in for about a $8 move, $8.75 move. So we can move up or down $8.75 based on that straddle. So that's by the week beforehand. So without earnings, right? Not including earnings. That doesn't include the earnings announcement. Excuse me, right here. Sorry. The week before does not include the earnings announcement, and your at-the-money straddle, that's more like it's about $6. $6.50, and that's kind of what I was looking at here. We can say, okay, well, let's say it does go up to $6.50 heading into that earnings announcement. So it doesn't stay here. We're kind of getting a little bit of a breakout move. Let's say, as it pushes outside these Bollinger Bands, and you can also see too, 3 green arrows with a decent amount of volume, and market forecast is looking bullish and turning higher, and so, let's say it starts to make a run towards, it would be what, 186 would be that $6 move. Well, so you add that on here on the Theo price, you add that into the equation. The time passing and the stock moving up would bring this vertical spread down to basically worthless by the time the earnings, the day before, at the close before the earnings announcement of the next morning. So even though volatility may hold prices up, if time passes and the stock moves, according to this breakout move, and we move up higher into, and you can, again, take a look at the earnings here, and you can see the stock price, as we head into earnings, some of these are bullish, and you can kind of see the move, the moves on the earnings aren't really too extraordinary in any of these. A little bit bigger the last few times, but nothing out of the ordinary there. If that continues to be the case here, then earnings really won't have that much of an impact on the spread that we do. Again, that we would expect the stock to rally, even if it wasn't for earnings, because of the patterns that we're seeing here on the chart. So as always, that wraps us up for today. I appreciate your time watching the Market Outlooks videos day in and day out. Thank you for watching again tonight. It's been an interesting market, a little bit of a breakout move this week. Is this more options expiration related, or is this actual, now we're bullish related? The market's ready to get going again here, or the stock market's ready to get going. That remains to be seen. Probably more the latter, or the former rather than the latter, that it's more light volume, expiration related, more likely to get some kind of near-term pullback before we can now feel better about backing up the truck to a degree and feeling more stronger about this new bullish posture we're on. So remember to subscribe, like, and comment on the video down below. Also remember to follow me on Twitter for more content like this throughout the day, as well as join our Market Outlook community on Facebook with the links down in the video description below. Thanks again for watching. Have a great evening, everybody, and we'll see you all next time.